Welcome back to BullionIQ, the channel where we break down finance, crypto, and digital assets in a way that is simple, clear, and actually useful. If you are new here, this is the place where I don't just follow hype. I analyze it like an expert and help you think like an investor, not a gambler. Today's topic is one of the most shocking and controversial ideas in the crypto world right now, and I want you to listen carefully. What if XRP's low price is not an accident? What if it is actually being kept low on purpose by some of the biggest financial institutions in the world? Imagine that for a second. An asset that many people say is dead or not moving is actually being secretly controlled. Not because it is weak, but because it is too valuable. Some insiders are now saying that big banks are intentionally keeping XRP under $3 so they can accumulate it cheaply before the real move begins. And if that is true, then what happens next could change the lives of many long-term holders. A few days ago, I came across an interview with a man named Dr. Jim Willie. Now, this is not some random guy on the internet. He is a financial analyst with a PhD in statistics. This is a numbers guy, someone who understands patterns, data, and how big money moves behind the scenes. And what he said honestly caught my full attention. According to him, some of the biggest banks in the world, along with a massive private equity firm, might have been holding XRP's price down on purpose. He even named major institutions like Bank of America and the Bank of New York Mellon. His claim was bold. He suggested that these banks are quietly working to keep XRP's price under $3, not because they don't believe in it, but because they want to buy as much as possible before the price skyrockets. Now, at first, I also thought this sounded like a crazy conspiracy theory. I mean, let's be honest, crypto is already full of wild claims every single day. But the interesting part was when he started giving actual reasoning behind this idea. He explained that if XRP should naturally be sitting around $7 or $8 right now, based on adoption and partnerships, then why is it stuck under $3? Why is it moving so slowly while other coins pump and dump like crazy? He believes that these big institutions may even be working together with Ripple itself to keep the price low for now. Imagine a conversation behind closed doors where banks say, "Help us keep the price low while we build our position. We don't want to buy at high prices." Now that sounds like something straight out of a financial thriller movie, but when you really think about how powerful these institutions are, it is not actually impossible. Ask yourself this simple question. If you knew for a fact that an asset was going to be extremely valuable in the future, would you want to buy it at a cheap price or an expensive price? Of course, you would want it cheap. It's like buying a stock at $10 that you believe will be worth $50 or even $100 in the future. Smart money always tries to enter early and quietly. Now, here's where things get more interesting. Dr. Willie pointed out that exchange wallets holding XRP have been shrinking in a massive way. For example, Coinbase reportedly held close to 1 billion XRP on their platform, but by September, that amount had dropped to around just 32 million XRP. Let that number sink in. That is not a small decrease. That is an extreme drop. So where did all that XRP go? It did not just disappear. His theory is that large amounts of XRP are being moved off public exchanges and sent into private wallets or institutional accounts. In simple words, big players are taking XRP off the shelves and storing it where regular people like us cannot see it. This is called silent accumulation. He also mentioned that non-disclosure agreements, also called NDAs, could be part of this. This means that certain exchanges or companies might legally be forbidden from explaining what is really happening. That would explain the silence. No big announcements, no drama, just quiet movement behind the scenes. Another interesting moment came when Larry Fink, the CEO of BlackRock, was asked publicly about a possible XRP-based ETF. Now, if you don't know, BlackRock is one of the biggest asset managers in the world. When he was asked about XRP, he did not say no, he did not say yes, he simply said, "I cannot say." And that answer made a lot of people raise their eyebrows, including Dr. Willie. If something was not happening, why not just say, "No, we are not working on that"? But when someone says, "I can't say," it often means one thing: something is happening, but I am not allowed to talk about it yet. To many XRP supporters, this felt like a very quiet but powerful hint. So now when you connect all of these dots, banks possibly suppressing price, huge withdrawals from exchanges, big institutions going silent, and hints of an XRP ETF, you start to see a very different picture. A picture where XRP is not being ignored. A picture where XRP is being prepared. Because now we are going deeper into how this theory actually works and why it is not as crazy as it first sounds. What Dr. Jim Willie explained was not just about banks secretly buying XRP. It was bigger than that. It was about pressure, financial pressure, supply pressure, and what happens when too much money starts chasing too little supply. Think about this in very simple terms. If there are 100 chairs in a room and only 50 people, everyone can sit comfortably. But if suddenly 500 people run into that room trying to grab one of those 100 chairs, then what happens? People start pushing, fighting, and doing anything to grab a seat. The value of that seat suddenly becomes extremely high. This is exactly the kind of situation that could be building around XRP. Dr. Willie explained that huge institutional money currently sitting in Bitcoin and Ethereum could begin moving into XRP. Now, this is very important. Bitcoin and Ethereum already have massive market caps. They are respected. They are safe in the eyes of big investors. But because they are already so big, the potential for huge, fast gains starts to become smaller over time. When that happens, big money looks for the next opportunity. That next opportunity, according to him, could very well be XRP. Now imagine this. Even if just a small percentage of Bitcoin and Ethereum money starts moving into XRP, it would be enough to shock the entire system. We are talking about billions of dollars. And XRP does not have unlimited liquid supply available on exchanges. If most of it is already locked away in cold wallets, institutional vaults, and long-term holding addresses, then the available amount that can be bought becomes very, very small. What happens next is simple economics. When demand goes up, but supply stays low or becomes even lower, the price has no choice but to rise, sometimes slowly, sometimes violently. This is what he calls the pressure cooker effect. XRP is like a closed bottle that is having more and more pressure built inside it. The cap is tight, the supply is shrinking, and the money that wants inside is increasing. Eventually, the pressure becomes so strong that the cap just explodes off. And when that happens, the price does not creep up slowly, it jumps, it shocks people, it creates disbelief. You see this in markets all the time. Assets that move slowly for years, then suddenly in a matter of weeks or months, they go up 5 times, 10 times, or even more, and people say, why did this happen so fast? But the truth is, it wasn't fast. The move was being prepared quietly for a very long time. According to Dr. Willie, XRP might be in that quiet preparation stage right now. He even suggested that if the price was not being controlled, XRP could already be trading between $7 and $8 based on current information, partnerships, and underlying technology. But instead, it is sitting much lower. And that difference between where it is and where it should be is creating tension in the market. Another point he mentioned was about time. Big institutions do not think in days or weeks. They think in years. While the average retail investor is looking for a quick profit by next month, institutions are planning for the next 5, 10, or even 20 years. So keeping XRP under $3 for an extra year or two is nothing for them. To them, that is simply part of a long-term accumulation strategy. And here is where things can become emotional for the average person. People get bored, they get tired, they sell, they move their money into something that is moving faster. This is exactly what weak hands do, and that is exactly what strong hands want. When regular investors give up, big investors step in and quietly buy more. It is a psychological game. The market is not just numbers and charts. It is human emotion mixed with money. Fear, doubt, excitement, greed, boredom, hope. Every single one of those emotions moves the market. And right now, boredom might be doing more damage to retail investors than anything else. While people are complaining that XRP is not doing anything, the biggest wallets might be doing the most important thing of all, accumulating. Now let's talk about ETFs for a moment, because this is another piece of the puzzle that cannot be ignored. When Bitcoin ETFs were approved, billions of dollars flowed into structured, regulated investment products. The same thing is now being discussed for Ethereum. Once that wave settles, institutions will start looking for the next asset that could receive the same treatment. And XRP is a strong candidate for that position. If an XRP ETF is announced or even hinted strongly, the demand would rise instantly, not gradually, not slowly, instantly, because now traditional investors would have a simple, legal way to get exposure to XRP without even touching a crypto exchange. That alone could create massive buying pressure. Now combine that with reduced supply on exchanges. This is where the real danger or opportunity is. If supply is low and demand suddenly spikes because of an ETF announcement or big institutional move, the price does not politely climb. It gaps, it jumps, it surprises even the most experienced traders. And this is why Dr. Willie believes the real XRP move will not be slow and boring. He believes it will be aggressive, emotional, shocking, and life-changing for those who stayed patient. Now, I am not here to tell you to buy or sell anything. That is your personal choice and responsibility. But my job as an analyst on BullionIQ is to show you possibilities that most people are ignoring, to show you patterns that are not obvious on the surface, to help you think before the crowd does. And when you look at XRP through this lens, it no longer looks dead. It starts to look like a sleeping giant. Let's take a step back and look at why XRP is so unique in the world of crypto. Most coins out there are either purely speculative or designed for very narrow purposes. But XRP has a connection to the global banking system that very few other cryptocurrencies have. This is where things get really interesting for investors who think long term. XRP was designed from the start to move money fast and cheaply. While Bitcoin is more of a store of value and Ethereum focuses on smart contracts, XRP's real strength lies in payments and cross-border transactions. Banks and financial institutions are always looking for ways to move money across borders faster, cheaper, and more securely. That's exactly the problem Ripple, the company behind XRP, aims to solve. Imagine a company sending millions of dollars from the US to Europe today. It might take days and cost hundreds of dollars in fees. With XRP, the process could take seconds and cost pennies. That is why Ripple built relationships with banks and payment providers around the world. And while there were skeptics initially, the banks that dismissed XRP before are now quietly exploring its technology and potential. Dr. Willie highlighted a critical point. Banks don't move blindly. They do detailed research and planning before adopting anything. If they were actively participating in keeping XRP under $3, it signals that they see massive long-term value. These are not small players. We are talking about multi-trillion-dollar institutions that would not waste resources on something they didn't believe could impact the global financial system. Another key factor is cross-border settlement. Today, most banks use a combination of SWIFT messages and correspondent banking networks to move money internationally. It's slow, expensive, and opaque. XRP can potentially bypass much of this system. That's huge because if even a fraction of global banks start using XRP for settlement, it would create demand that far exceeds the available supply on public markets. Willie also pointed out the RLUSD concept, Ripple's stablecoin tied to the US dollar. Imagine countries using XRP and RLUSD for trade settlements instead of dollars. The potential market isn't just retail investors or small traders, it's entire governments and corporations. That could mean XRP's value is tied to real massive flows of money, not just hype or speculation. Now, let's think about adoption patterns. Traditionally, banks move slowly. They require regulation, testing, audits, and legal approvals. But once they adopt something, the adoption is sticky and long-term. Unlike retail investors who might panic sell, banks hold and transact steadily. That stability could act like a backbone for XRP's price growth over years rather than the typical boom and bust cycles we see with other coins. And this is why the disappearing XRP from exchanges is so critical. If these large institutions are quietly moving coins into private wallets and vaults, they are essentially locking away the supply. That reduces what's available for regular traders and increases the scarcity factor. Scarcity plus future demand equals potential price appreciation. The math is simple, and it works in every market. Dr. Willie also mentioned how previous skepticism from banks is fading. Firms like JP Morgan, which once appeared to compete with Ripple, may now see XRP as a tool rather than a rival. The shift in sentiment is significant because it means the very institutions that once criticized crypto might soon be the biggest supporters. That's a dramatic change in perception and could be one of the main catalysts for adoption. But let's not forget the human factor. Even with all this planning and strategic accumulation, retail investors still matter. Large institutions often watch sentiment and market behavior closely. If they sense panic selling or irrational hype, it can accelerate their moves. That's why being informed, calm, and prepared is so important for anyone holding XRP. Knowing the technology, supply dynamics, and potential adoption paths gives you an advantage that emotion-driven traders do not have. Finally, when we combine the global banking adoption, the ETF possibilities, and the pressure cooker effect, the potential scenario for XRP becomes clear. It is a coin quietly being positioned for massive impact. Not overnight, but over a timeline measured in months or years. The real question is timing, patience, and being aware of the signals that show institutional activity. ETFs or exchange-traded funds. If you've ever invested in stocks, you probably know ETFs are a way to invest in a bundle of assets without buying each one individually. In crypto, ETFs allow mainstream investors and institutions to gain exposure to a cryptocurrency like XRP in a regulated and simplified way. And this is where things could get really interesting. Dr. Jim Willie emphasized that once an XRP ETF launches, it could bring in a flood of capital that retail exchanges alone cannot handle. Imagine billions of dollars from traditional investors suddenly entering XRP without touching Coinbase, Binance, or Kraken. This is money that moves quietly but massively. Unlike retail traders, institutional investors don't panic sell. They plan, strategize, and accumulate strategically. That makes their moves far more impactful. The ETF effect is compounded by supply limitations. We already talked about XRP disappearing from exchanges. Large chunks are moving into private custody and institutional vaults. Now, if ETFs start buying more, the available XRP for regular traders becomes even smaller. Simple supply and demand logic tells us that scarcity in the face of increased demand pushes prices higher, and often very fast. Willie also pointed out another subtle but critical factor. ETFs create legitimacy. For years, many investors avoided XRP because of regulatory uncertainty and skepticism from traditional finance. An ETF approval signals that regulators, big investors, and financial institutions view XRP as credible. That perception alone can trigger waves of new interest and inflows, creating a self-reinforcing cycle. More legitimacy, more demand, higher prices, even more legitimacy. Here's a key detail to understand. Institutional accumulation is not just about the immediate price. Banks and funds aim to hold large amounts of XRP for long-term utility. They might use it for settlement, liquidity management, or even as a hedge against dollar exposure. This means that XRP held by institutions is effectively removed from circulation. When the ETF starts attracting additional buyers, there will be fewer coins available to sell. This is exactly how a price squeeze can occur. Now think about the timing. ETFs take time to launch. Between announcement and execution, large investors often start accumulating quietly. They don't want to buy too much too quickly because that would spike the price before the ETF even begins. But this quiet accumulation sets the stage for the explosive moves once the ETF is live. Early participants stand to benefit the most, while latecomers may find XRP suddenly much more expensive. Willie used a simple analogy here. He compared XRP to a sponge. When you squeeze a sponge, water comes out gradually. But when pressure builds too much, the sponge can no longer hold it, and water bursts out all at once. XRP's supply shortage combined with ETF-driven demand is like squeezing that sponge. The moment the institutional pressure reaches a tipping point, the price could surge dramatically. Of course, there are risks. No market move is guaranteed. ETFs could be delayed or face regulatory hurdles. Institutional interest might not translate into immediate buying, or unforeseen market events could create volatility. That's why Willie stresses patience and preparation over speculation. Retail investors who panic during sideways markets risk missing the accumulation phase, while those who stay informed could see the full potential when the market moves. Another point Willie highlighted is the psychological effect of institutional buying. When traders see big names quietly accumulating, it sends signals to the market, even if indirectly. People start to notice, sentiment improves, and FOMO, fear of missing out, begins. The combination of real institutional moves and market psychology can magnify the effect on price. Finally, ETFs don't just bring money, they bring infrastructure. Banks, custodians, and fund managers get involved, ensuring safe storage and smoother transactions. This reduces one of the biggest barriers for crypto adoption: security and trust. When mainstream finance trusts XRP, the retail market gains confidence too. This alignment of large-scale adoption, limited supply, and growing legitimacy is exactly what could set XRP apart from most other cryptocurrencies. Banks quietly accumulating XRP, ETF-driven demand, and the pressure cooker scenario. It's time to talk about what this means for retail investors like you and me. The crypto world can feel overwhelming, especially when you hear wild predictions or insider theories. But there are practical ways to prepare without taking unnecessary risks. First, knowledge is your most powerful tool. Understanding supply dynamics, institutional behavior, and potential catalysts like exchange-traded funds helps you make informed decisions. Don't rely solely on hype or social media chatter. Track wallet movements on exchanges, watch for large outflows, and pay attention to regulatory announcements. These signals often tell you what's happening behind the scenes before the price reacts. Second, patience is key. If Dr. Willie's theory is correct, XRP is quietly being accumulated by big players right now. The retail market may appear stagnant or slow-moving, but that doesn't mean nothing is happening. In fact, the sideways action could be a crucial accumulation period. Selling in frustration during this phase is often the worst decision a retail investor can make. Diversification also matters. Even if you believe XRP has huge potential, it's risky to put all your crypto holdings in one coin. Spread your investments across multiple assets with solid fundamentals. Bitcoin and Ethereum remain leaders, and projects like Cardano or Polkadot could provide additional growth opportunities. This approach minimizes the impact of unexpected market events on your overall portfolio. Third, consider timing and position size carefully. Institutional moves take months or even years, so you don't need to rush. Start by allocating a portion of your portfolio to XRP based on your risk tolerance. Think of it as building a long-term stake rather than trying to time the exact bottom. Dollar cost averaging, investing regularly over time, can reduce risk and prevent panic buying or selling during volatile days. Another important point is security. With large inflows and institutional interest, exchanges can get crowded or even hacked. Keep a portion of your XRP in secure wallets, preferably cold storage, rather than leaving everything on exchanges. This protects you from sudden exchange outages or attacks and ensures that your coins are safe no matter what happens in the market. Willie also highlighted community insights. Being part of a knowledgeable network of crypto enthusiasts can help you spot trends and signals faster. Discord groups, forums, and newsletters provide discussion, news updates, and educational resources. However, always verify information independently. The crypto space has its share of misinformation and AI-generated content, so staying critical is essential. Risk management cannot be stressed enough. Cryptocurrencies are volatile. Prices can swing dramatically within hours, and even well-researched theories may not play out as expected. Never invest more than you are willing to lose, and avoid making emotional decisions based on fear or greed. Use stop-loss strategies, track your investments, and plan exit points, but remain flexible enough to adapt to market changes. Next, think long-term. XRP isn't just about short-term gains. It's about its potential role in global finance. If Ripple's technology continues to gain adoption, if ETFs launch, or if banks integrate XRP for settlements, the growth could be substantial. But this will likely happen gradually, with periods of sideways movement and minor corrections along the way. Expect a roller coaster ride rather than a straight upward trajectory. Finally, stay informed but stay calm. Markets move fast, and crypto news often creates panic or hype. Take a step back and focus on fundamentals, supply dynamics, institutional interest, and regulatory signals. Combining careful observation with disciplined investing gives you the best chance to participate in XRP's potential upside without falling victim to hype traps. In conclusion, whether Dr. Willie's theory is fully accurate or just a part of the bigger story, it teaches an important lesson. The crypto market is more than just prices on a screen. It's about supply, demand, institutional strategy, human psychology, and emerging financial infrastructure. By staying informed, managing risks, and preparing for long-term possibilities, retail investors can position themselves wisely. Here at BullionIQ, my goal is to provide clarity amid all the noise. We break down theories, analyze trends, and help you understand the bigger picture so you can make educated decisions. Remember, XRP's journey is far from over. Whether it quietly accumulates value now or surprises us later, having a plan, patience, and knowledge is your best strategy.